Well, taking a look at June's non-farm payroll report, it missed Wall Street's expectations for the first time in 15 months. But many economists say it isn't a strong enough sign to indicate softening in the labor market. Our Josh Schafer is here with a breakdown on why Friday's jobs report likely didn't change the thinking of the Federal Reserve. What's your take, Josh?
Yeah, Rochelle, so you saw that non-farm payroll number miss for the first time in 15 months, coming in below Wall Street estimates for the first time in 15 months. But when you take a look at the Fed fund futures and what we see investors trading in that market, we didn't see much movement. So when you take a look at that CME chart from the Fed fund futures, you can see here still about a 93% chance of a rate hike come July. That number was pretty much right around 93% coming into the report on Friday. So I want to take a look at some of the key charts from that report and really why we're seeing that. When we go to the overall non-farm payroll employment number, you see 209,000 jobs still added. Now, again, below Wall Street estimates, which we always talk about, but 209,000 jobs added is no small number. A lot of economists are looking for that number to come below 200,000 before we see sustained slowing or slowing down in the economy, and also a more consistent number. Remember, we had over 300,000 jobs added in May, so it hasn't been very consistent yet. That's one key thing to highlight with payrolls. When you take a look at the unemployment rate, that's still historically low as well, sitting down here at 3.6%. You can see how much lower that is than what we saw over the past decade. That is something that Chair Powell has highlighted multiple times, and economists keep harping on because that actually came down from 3.7% down to 3.6%. And then when you take a look at wage growth, a key thing to think about when you're talking about inflation is how much money are people making? Well, people are still making more money. You see wage growth increased 4.4% last month. Again, historically higher than what we saw over the last decade. And another number economists keep highlighting when we talk about can people continue to fight through sticky inflation? Well, if they're making more money, they probably can. And that means companies can keep prices higher and inflation overall would remain higher. Now, another thing I wanted to take a look at that is becoming more of the discussion, Rochelle, is the CME futures when we take a look at November. So right here you can see this would be 50 basis points up from where we are now, and this would be 75 basis points up from where we are now. That's together combined about a 40% chance by the time we get to the end of November, the Fed has raised their benchmark interest rate by about 50 basis points or maybe even 75 basis points. If we go back a month ago, before all this strong economic data we've been talking about for the last month, there was only about a 10% chance of people pricing in a 50 basis point move by November. So we've seen a lot of movements actually not in the July numbers. That interest rate hike is largely priced in. Where we're seeing movement now is come September, come November, and people thinking instead of 25 more bits for the Fed to go, it might be 50, which certainly changes things a little bit when we think about the market and we think about what it means overall.
Indeed, the Fed keeps saying higher for longer. It looks like the markets are starting to believe it. Our very own Josh Schafer there. Thank you so much.